Hi guys, welcome back to my channel. Kelvin here. Have you always wanted to start investing, but then your parents tell you to stay away from investing? The conversation goes like, hey dad, I want to start investing. Aiyah, stocks so risky. Many people jump off from tall buildings because of stock. But Kelvin say that investing is good. Buying stocks is gambling your money away. But dad, no buts. You say some more, no dinner for you tonight. Then the conversation just ends there. Are our elders actually right? Or is it just old school thinking? In this video, I will show you all of the myths of investing, and I will try to debunk them one by one. Before I start, if you are new here, do subscribe to my channel. I post every Monday talking about personal finance stuff like credit cards and investing. Tap the bell button to get notified whenever I post a new video. And without further ado, let's start. Number 1. Investing is risky. Yes, investment is risky. There is no denying it. However, that is only part of the truth. Anything you do, there is always a risk. Even saving money at the bank has its own risk. The bank could just go bankrupt. The inflation could just eat away at your money. Here's the simple truth. When people lose money in the stock market, it is always caused by two main reasons. The first reason, greed. New investors are always looking to get rich quick. They try to day trade, buy low and sell high, thinking that they could be the professionals, but instead, they bought high and sold low. The second reason, new investors don't understand what they are investing in. When they invest, all they see is just stock price, stock price. Even the news glorifies stock price. The market has surged up, the market has crashed down. However, behind the financials, there's actually a real company right there. But new investors don't really take the time to understand the company. Like, is the financials good? How are the management? Who are their competitors? Yes, investment is risky, but in the long term, the market will always go up. The S&P has been delivering a 9% average return for the past 90 years. That alone tells you, if you invest long term, and if you understand what you are investing in, the risk is very minimal. Number 2. Investing is complicated. Stocks, bond, ETF, index fund, mutual fund, and so on. Investing is so overwhelming to new investors. Investing is complicated, but we actually can get by just knowing only the basics. Like when you play basketball, you only need to know how to dribble and 2-point shooting. Newbies do not need to know all the advanced moves like slam dunk, pump fakes, blocking, 3-pointers, crossovers, and so on. So what's the easiest way to start investing? One word, index funds. Wait, there's two words. Index funds is basically a group of stocks representing a certain market. For example, a group of US stocks, a group of tech stocks, a group of property stocks, and so on. The great thing about an index fund is first, it is well diversified by having a lot of stocks in one group. And two, it is self-cleansing because if any stocks in that group underperforms, the index fund will kick away the stock and replace it with another better stock. So you don't really have to manage an index fund. All you need to do is just figure out what index funds to buy, then just buy it over and over again. Or just watch my video on index fund recommendations. Even the legendary NBC investor Warren Buffett was so confident in index fund that he made a 1 million bet against fund managers that they will never outperform a simple US index fund. And he won. Just think about it. All these fund managers have all the sophisticated tools, latest market data, a team of professionals, and they still lost. So yes, investing is complicated, but you can avoid all of this by just investing in index funds. Number 3. I can always invest when I'm older. You totally could, but the longer you wait to invest, the more you stand to lose. Because of a simple term, compounding effect, which is the longer you invest, the faster it will grow. Check out this chart by Business Insider. Emily started investing at 25 years old, while Dave started at 35 years old. At 65 years old, Emily has 400k while Dave has just half the amount. Every month you wait to invest is every month less of compounding you will get. So start investing today. Number 4. I need a lot of money to invest. When people think of investing, they think of professionals wearing suits, monitoring the exchange of millions of dollars on the stock ticker board. The truth is, you do not actually need a lot of money to start investing. Even with just a few dollars, you can already start investing and grow your money with compounding effect. Check out this great article by Sidley. These are some of the robo-advisors available. A robo-advisor is just a computer program that uses algorithms to help us to invest. And because they are not using real humans, the fees are actually much cheaper than a traditional fund manager. There are robo-advisors that do not require minimum investment, like Crystal AI, Squirrel Safe, Stash Away, Safe. As long as you have extra cash lying around, you can already start to invest. Remember, the important thing is not about how much you invest, it's about how early you invest. Number 5. I can time the market. Almost every new investor, including me, think that he or she can time the market until I suddenly remember, how can I time the market that is so complicated when I can't even time a simple stun in Dota? A study by eToro found that over 80% of the traders lose money. That means 4 out of 5 traders fail to time the market. Why are so many people confident in their skill in timing the market, yet so few manage to actually do it? It is due to something called Dunning-Kruger effect. The people with low competence at a task tend to overestimate their skill, and because of that, they do not have the ability to recognize their mistakes and errors, making them exceptionally confident. This is the same in trying to time the market. Many investors, including newbies and professionals, think that they can predict how the market is going to go next. Check out this chart by John Bowman. He has been tracking what the professionals are saying versus what is happening in the market. Like in 2012, Mark Faber won, prepare for massive market meltdown. Ron Paul, 2014, stocks are in a bubble and will crash. RBS 2016, sell everything, brace for cataclysmic year. Even Morgan Stanley, 2018, we think the selling has just begun. All of it, the market kept going up and up. This just goes to show you that no one can actually time the market. Anyone that claims that they can do so is just bluffing. So don't even try to time the market. Number 6. Sell when the market is in trouble. You all have heard this quote before. Buy low, sell high. Naturally, when the market is in trouble, you will want to sell your stocks away. However, as I've mentioned just now, no one can actually time the market. There's a research by JP Morgan which found out that the best days in the market usually happen right after 2 weeks of the 10 worst days. And you know what? It just happened again recently. If you had panicked sold in early March, you would have missed out on the spectacular run-ups of our time. If you had just held on, your portfolio would have recovered back to normal already. The JP Morgan study also found out that over 20 years, if you had missed on the 10 best days, your returns dropped by more than half to just 2%. And if you miss out on the 20 best days, it is already in negative territory. Just think about it. By missing out on just 20 days out of 20 years, your portfolio would be underperforming someone who actually held on through all the market ups and downs. So if you don't need the cash when the market is in trouble, just hold on. Sometimes the best thing to do is just do nothing at all. Number 7. I have to monitor the market. Whenever a new investor buys into a stock, he or she would monitor the stock price every day, and it would absolutely wreck his emotions. If the stock price goes up, he will be super happy. If it goes down, he will be super depressed, thinking, am I stupid? Did I do something wrong? Of course not. Tell yourself, I'm not stupid. Here's why. Legendary NPC investor Benjamin Graham once said, in the short term, the market is a voting machine, but in the long run, it is a weighing machine. In the short term, the market will move depending on whether there are more buyers or more sellers. So it's kind of like a voting machine. But in the long term, the stock will always reflect the real value of the company, whether it is a lousy company or a great company. Just take a look at this chart. This stock in the 1980s was trading less than 50 cents, but now it is near $300. Guess what stock it is? Well, it is none other than Apple. Just over 30 years ago, no one wanted to buy Apple stock, but now it is worth so much. So remember, you don't have to monitor the stock market. If you have bought the correct stock, in the long term, the stock will show you its true value. Warren Buffett said it best, only buy something that you will be perfectly happy to hold if the market shut down for 10 years. Number 8. I invest only in companies which I'm familiar with. Sure, investing in familiar companies means that there's less work to be done. Like, let me invest in BreadTalk. because I eat bread that talks every day. Don't be silly, bread can't talk. Or do they? If you are only investing in companies that you are familiar in, you will be missing out on a lot. Maybe you eat Old Chang Kee often and you decide to buy its stock, but instead, the market has eaten up your money because the company has actually been losing money. Instead of choosing stocks that are familiar, look for stocks that will give you a great return over the years, like Maple Logistics. They have been steadily increasing their dividends over the years. Or if you are the kind that is okay with taking risks, you could invest in Tesla. The company looks promising and is quickly becoming the next big car company in the future. Whatever stocks that you decide to invest in, always look for stocks that will give you the best returns for your investments. Number 9. The professionals are better at investing. You might be thinking, the professionals are better at investing. Maybe I should leave my money with them because compared to me who knows nothing, they have all the data, they have teams of professionals, and they know how to invest. Now, before you go hand your hard-earned money to someone else to invest, take a look at this. According to a study by S&P Dow Jones, in 1 year, 64.5% of fund managers underperformed the simple S&P 500. After 10 years, 85.1% underperformed. And after 15 years, 91.6% of fund managers underperformed the market. Just think about it. In the long term, 9 out of 10 professionals underperform the market. Sure, maybe sometimes professionals will outperform the market, but most of the time, they don't. Professional fund managers are not any better at investing than you or I. So, instead of letting someone else invest your money for you, it is much better to invest yourself and save some commissions along the way. As to what you can invest in, as I've mentioned earlier, you could invest in index funds, or if you are interested, you could check out my stock recommendations. Number 10. I don't have to invest. Many people opt out of investing, thinking that investing is hard. Investing takes time and they could potentially lose all the money in investing. By not investing, sure, you will avoid potentially losing your money in the stock market. However, did you know that by putting your money in the bank, you will have a 100% chance of losing your money due to inflation? The average inflation rate in the United States is about 2% annually. That means if you have $100 sitting in the bank, you lose 2% in the first year alone. And it keeps becoming smaller and smaller each year until you are left with just a fraction of your money when you finally retire. But if you invest, your money can actually grow faster than the inflation. Look at this chart by Sean Rowe. Let's say we start at 10k in 2005. 10 years later, the saver will have 11k, but the investor would have 22k. This is even after the 2009 market crash. By only saving money and not investing, you're only playing not to lose. But by investing, you're actually playing to win and you stand to gain a lot more. And that's all for today. Let me know down in the comments below what other investing myths that you know of. Like, share and subscribe as I'll be posting new videos every Monday. See ya!